Hello and welcome to Questioning the Manager. Today I'm joined by John Bennett, Fund Manager for the European Focus Trust, which invests in European companies with the aim of maximising shareholders' total return. John, thank you for joining us. Last year was a fantastic year for European growth, and although that doesn't necessarily spell stock market growth, the European market did have a good year. What are your expectations for 2018?
Yeah, I mean, I guess as ever, I would caution against any sort of read across from strong economic growth to markets. You know, markets are often a sell. Equity markets are often a sell in booming economic times. Equity markets are a buy in recession because, of course, that's when you get bargains. I did go into 2018 really quite, and we've written about this actually in the investment trust report recently. I was quite struck by this consensus going into January that this was a tremendous global synchronized growth situation. I actually took the other side of that in that I said, well, actually, I think that the early months of 2018 would be seen as the high watermark for that global GDP picture. And I think that's actually coming to pass. And one of the big indicators for me was actually if you looked at monetary aggregates, they were already signalling that this could be as good as it gets in terms of the delta of global GDP growth, the rate of change. So I actually think there was an opportunity in January of 18 to reduce exposure, not just to equities in general, but to cyclicals in particular.
You spoke there about money aggregation. Can you just clarify what you mean there?
So when I talk about monetary aggregates and what they were signalling going in at the turn of the year, monetary aggregates being M1, M2, M3, so money supply growth, the rate of change in money supply. They were actually signalling classically at a time when the commentariat consensus was saying global GDP growth synchronized, isn't it great? Europe's joined the party as well, and Europe did join the GDP party, such as it was as ever late. But again, looking at the M1, M2, M3 money supply growth, to me it was indicating actually that it was as good as it got. And I think that's just coming to pass. It doesn't mean that recession is imminent here or there, although I do think the chances of an industrial recession in the US, for example, in the next 12 months are probably quite high. But I think it just what it meant was that it wasn't a time in January 2018, in my view, to get excited about equities in general. I didn't see any bargains. And specifically, I don't think it was time to be bullish on cyclicals.
So in terms of the trust list, have there been any significant movements in or out of the portfolio, or has the size of the trust list changed at all?
I think the most significant change in the portfolio, and you know, that's in a context of we haven't really, you know, swung the bat. There haven't been enormous changes at all. But I think the most significant change has been a reversal of a decision that we took, which was really quite contrarian at the time. In the third quarter of 2016, we bought banks, which of course had been the sort of poster child sector of European value investing. And understandably, we got a lot of pushback back then when we bought the banks. Going into 2018, as part of a reduction in exposure to cyclicals, we started to unwind our bank exposure. So we're actually underweight banks as we speak. That's definitely the most significant decision we've taken in the trust in recent months. A reduction in cyclicals in general, but specifically banks. And there's two reasons for that. Banks had re-rated. Expectations, I felt, were for the long end of the yield curve to continue to back up. So yields to go higher at the long end of yield. Treasuries, US Treasuries hit almost 3% in yield terms, 10-year yields, in January. And consistent with my view on world GDP growth expectations, I felt that actually might prove a bit of a high watermark, at least in the short term, in the absence of any inflationary pressure. Second reason was, and this is more strategic, I do worry the more I look at banks, the more I talk to bank management, I worry about, and it's very long term, I worry about digital disruption coming into more and more banking models. So that's a long-term reason to be cautious on many banks, not all. Shorter term one is that yield curve situation. So once again, which is actually our normal state, once again underweight banks.
Last time round you spoke about a bottom-up approach to the stock selection with no real sector-level themes. How are you finding 2018 so far? Have you identified any themes or is it much of the same?
No sector themes. So unwound the banks, that's profit taking. But it is, for me, 2018 is a year not about sectors. It's a year for stocks. One good thing is volatility's come back. I mean, welcome back volatility. It will be interesting. Again, this is more strategic thinking. It will be interesting if volatility is back for real, as in it's not just a 2-month or 3-month or 4-month event, but if volatility really is back, I think I look forward to a challenge to the passive versus active debate. You know, it seems that passive is a one-way winner. I'm less convinced about that in a more volatile environment. But it is, as a stock picker, it is nice to see volatility back. I don't think it's about owning oil or pharma or banking. I think it's about which oil stock, which pharma stock, which banking stock. It might be none, but it might be one or two. I really do think it's about stock specifics this year.
John Bennett, thank you for your time.
Thank you.